Markets opened the week with a sharp gap higher after the latest U.S. jobs report, but that optimism quickly evaporated. What began as a hopeful surge turned into a collapse as heavy institutional selling poured in. Traders call this move a rug pull, when the floor gets yanked out. Just as investors are feeling bullish, the reaction was dramatic, but it also fits a familiar historical pattern. The U.S. labor market is showing weakness, and the Federal Reserve is poised to begin a rate-cutting cycle. Many traders expect that rate cuts should provide support for risk assets like equities. But history suggests something different. If we look back over the past several decades, markets often peak before or just as the Fed begins cutting rates. The reason is simple. The Fed does not cut rates when the economy is healthy. They cut when conditions are deteriorating, when growth is slowing, or when the labor market is faltering. That means the first rate cut is rarely a bullish signal. It is usually a confirmation that the economy has entered a vulnerable stage. Take the year 2000. After the tech bubble, the Fed started cutting aggressively. Instead of rallying, markets fell for more than 2 years. In 2007, the Fed cut rates as the housing market cracked. Equities rallied briefly, but the moves were short-lived, and we know what followed: the financial crisis. Even more recently, in 2019, the Fed cut rates in response to trade tensions and slowing global growth. Stocks initially cheered the move, but volatility surged soon after, culminating in the sharp sell-off of 2020 when the pandemic hit. The pattern is clear. Markets rarely fall because of rate hikes alone. Instead, the trouble comes when the cycle flips, when the Fed acknowledges weakness and begins to ease policy. That shift signals the slowdown is already in motion. Today, we are watching a similar setup unfold. The labor market is flashing stress. Jobless claims have been climbing, private payrolls are slowing, and unemployment is threatening to rise to its highest level since 2021. That data triggered a knee-jerk rally as traders bet on quicker rate cuts. But the selling that followed shows a deeper concern. Smart money is positioning not for a relief rally, but for a downturn. When institutional selling becomes frantic, it tells us that large players are no longer willing to hold risk through economic uncertainty. They are raising cash, rotating into defensive assets, or piling into safe havens like gold and treasuries. For retail investors, this creates a dangerous environment. Price action looks bullish on the surface, but just beneath, liquidity is drying up and sellers are in control. Technically, this move also fits the script. A gap higher, followed by a swift reversal, is a classic exhaustion signal. It traps buyers at the top, forces weak hands to panic sell, and accelerates downside momentum. Traders call it a rug pull for good reason. Those left standing are often caught off guard. Looking ahead, the key will be how the market reacts to the first official rate cut. If history is any guide, the first cut will not be the end of pain, it may be the beginning of it. Equity markets may struggle, while defensive assets outperform. For investors, the lesson is to be cautious. Don't mistake rate cuts for an automatic green light. Ask why the Fed is cutting. If the answer is economic weakness, then the path forward is rarely smooth. In short, what we saw today may not just be a one-day rug pull. It could be the first sign that the market cycle has shifted.